Let's get in Kaustubh Belapurkar of Morningstar to talk about what he makes of this and what the impact on the NAVs and the result and in the future, in the near future, could be as well. Kaustubh, good having you. Thanks much for joining in. Good morning. 75% markdown already. I would reckon another 25% of a markdown would happen because of the default rating today.
So that, because the way the valuation guidelines have been defined, 75 to 100. So I think there's a little bit of flex, but I think a large part of the markdowns already happened. And if you see yesterday, even CARE did put a default rating on the NCD, so now pretty much all the instruments have been put down to default. So that, will obviously look at, the mark-to-market basis has impacted largely already, but I think there could be some more down to zero that does take place. But more important is, I think, earlier in the conversation we were speaking about that, DHFL obviously has been continuously working towards monetizing assets, securitizing their loan books. I think that's what's very important to keep monitoring, from that perspective as to how they keep honoring their commitments, because that's going to keep the ball rolling. The valuations, again, may not come back in a hurry despite them honoring their, because there is a curing period. You need to see if there's enough payments that are happening over a period of time before they can value the securities back up. So there is going to be a period where these mark-to-market, impact is going to remain. But I think investors just need to remain steady in these funds, because there's no point redeeming at this point.
All right. So the curing period of 7 days, if we do see DHFL make good, do we reverse the write-downs?
So I don't think the reversal is going to happen right away. So even if you have this, payment coming in over the 7-day period, even if you look at the rating notes that have come about from the rating agencies, clearly there is, there's more outflows that are going to be happening through June to August, and there is currently a liquidity mismatch of almost 4,000 odd crores. So it'll really be dependent, A, on how DHFL kind of tides over that, and B, even if there is a markup that's happening, it's going to be graded. It's not going to be as, in that one swift motion of 75% haircut that is applied. It's not going to be a similar mark back up in this case, because clearly they need to see a demonstration of consistent repayments continuing to come over a period of time, adequate visibility on payments before, they will start grading the bond ratings back up. So it's going to be a more graded mark-to-market back up, if at all, but it's not going to happen in a hurry. That's the way it will be.
So what should an investor, a mutual fund investor, do now? Because one, if DHFL pays the interest back in the cure period, there might be a graded markup. The NAVs don't come back in a hurry, but the damage to the NAVs is already done, and the remaining the damage will be done this morning. So what should an average investor do now?
So, to be honest, Neeraj, this impact's already coming. So there is absolutely no reason for exiting the fund right now, because, you've taken the brunt of the impact. It's happened. And like we were saying that, DHFL has demonstrated that they are, making those efforts to, stake sales, securitizing, all of that they can do, they're doing. Obviously, there has been delays, and that's what even the rating agencies have noted, that the pace is not what they would have liked it to be. So that is going to be an overhang, but it can only be a positive from here. So taking money off the table, and someone very rightly said, that in a debt instrument, if you take money off at a mark-to-market loss, that profit is booked for life. Unlike an equity instrument where you market falls, you can get back in at the reduced valuation. In a bond instrument, you take mark-to-market losses. That's something for life. So I think that's something investors need to be wary of and not really panic. I know it is a little bit of a troubling scenario mentally right now, but you just need to think that, okay, I'm going to be patient. This money was something which I'd passed away for some period of time. I just need to ride the wave, and things will kind of eventually, hopefully, kind of at least come back to some sense of normalcy.
All right. Kaustubh, just one last question. Obviously, we've seen a default in interest payment for certain NCDs that were scheduled for 4th of June. What about the longer dated, exposure that they have, and where there is a possibility that they'll actually meet those deadlines and meet those maturities? Do you see a significant change happening with regards to NAVs on those longer dated exposures?
So right now, the mark-to-market's been applied to pretty much all bonds, right? That's happened across the board, and like I was saying, that will truly be dependent on how much visibility there is there, even to the rating agencies in terms of future liquidity that DHFL can generate through strategic sales, through securitizing their loan books. All of that is going to be very, very keen in in visibility and demonstrating that at a probably a faster clip than they've already done. I'm sure they're doing all they can to give a semblance that okay, yes, liquidity is probably tido and shouldn't be a problem. And again, like I said, only that visibility will give comfort to the industry for them to start marking those back up. It will be graded. It's not going to be one swift action to mark it back up to the original valuation.
Okay, Kaustubh, appreciate you taking the time out and joining and giving us that perspective.